Welcome to The Explainer. Today we're diving deep into the investment case for Stellantis, an absolute giant of the auto world that has just been hammered. The real question is there value buried in this wreckage, or is this a company that's truly broken? Let's find out.
So right off the bat, here is the central puzzle. You have a company with 150 billion euros in revenue, a company that owns iconic money-printing brands like Jeep and Ram, and yet its stock is trading as if we're back in the darkest days of the 2020 pandemic. How does that even happen? What is the market seeing that has it so spooked?
At a price like this, the market isn't just whispering its concerns, it's screaming that this company is fundamentally and maybe permanently damaged. So our job today is to act like financial detectives. We need to pick through the wreckage and figure out exactly what happened.
Okay, let's begin our investigation by looking at the decisions that led to this crisis. And really, it all comes down to a massive, high-stakes gamble on electric vehicles that just went completely off the rails.
You see, the previous leadership went all in. They committed over 30 billion euros to a super aggressive, super fast transition to EVs. The only problem? They forgot to ask the customer. Consumers, especially in the US, just weren't ready. They looked at the high prices, the range anxiety, the spotty charging infrastructure and said, no thanks. The result was a catastrophe, a mountain of unsold cars piling up, a dealer network in open rebellion, and a CEO shown the door as the company's financials went into a nosedive.
And this slide, this really gets to the heart of the matter. You had this massive disconnect between the company's top-down strategy and what its customers were actually asking for. While the C-suite was laser-focused on hitting EV targets dictated by policy, their loyal customer base was still clamoring for the rumbling, gas-powered Hemi V8s that made brands like Dodge and Ram famous.
And let's be really clear about something. The legendary Hemi V8 wasn't discontinued because people stopped wanting it. Far from it. It was killed by the cold, hard math of government regulations. The company was facing gigantic emissions fines for every V8 they sold, to the point where one of its most popular and profitable products became a financial loser.
All right, so we've seen the strategic blunders. Now let's look at the financial fallout. The numbers here paint a really grim picture of just how quickly a massive company can find itself in deep, deep trouble.
And wow, look at this chart. This shows the free fall. The company's adjusted operating margin, which is basically how much profit they make from actually building and selling cars, collapsed. It went from a very healthy 12.8% to literally negative in just a couple of years. All of a sudden, their core markets were just bleeding cash.
The damage to the company's financial foundation was just as bad. They used to brag about their fortress balance sheet with way more cash than debt. Well, that fortress came crumbling down. In one brutal year, they went from a strong net cash position to being nearly 16 billion euros in the red.
And here's the price tag for that failed strategy. A staggering 25.4 billion euros. Let that sink in. That's the cost of writing off all those failed EV projects, scrapping vehicle programs, and dealing with warranty claims. This one charge led to a net loss of over 22 billion euros for the year. Just an incredible amount of value destroyed.
So if you were a shareholder, this is where you felt the pain directly. The dividend? Gone. Share buybacks? Halted. The company slammed the brakes on all capital returns. It was all about one thing and one thing only: survival.
But this is where the story pivots. Just when things look their absolute darkest, you have to ask, is there an opportunity here? So now, we're going to lay out the bull case, the argument for why this wreckage might actually be a deeply mispriced golden opportunity.
And the bull case isn't just hope and a prayer. It's built on four pretty solid pillars. First, survival. They have a massive 50 billion euros liquidity cushion. That gives them years to sort this out. Second, new leadership. They brought in a new CEO who is a hardcore operations guy with a history of success. Third, a product pivot. They're going back to a freedom of choice model, giving customers what they actually want. And fourth, they have some smart strategic hedges, like their partnership for low-cost EV tech.
And the new CEO's message is just a breath of fresh air. He's not out there making flashy, grandiose promises. His mantra is execution. It's all about getting the basics right, under-promising, and then over-delivering. That is exactly what you want to hear from a turnaround story.
And listen, it's not just talk. We're already seeing some early, tangible signs of life. The pivot back to what customers want is already working. Shipments in North America surged. U.S. orders went up 150% year-over-year in the fourth quarter. The new gas-powered Dodge Charger, it's sold out, instantly. And most importantly, the rate at which they're burning through cash has started to slow down.
So that brings us to the core of the investment thesis, the valuation. The stock is so beaten down, it's as if the market has priced in a 0% chance of this turnaround succeeding. Let's actually dig into the numbers and see just how cheap it is.
And as you can see, no matter how you slice it, Stellantis is trading at a massive discount to its peers. On key metrics like enterprise value to revenue or price to book, it's not even in the same ballpark. It's trading for just a fraction of what other major automakers are worth.
So, what could that mean for the stock? Well, if you run a pretty conservative discounted cash flow model, and you assume that margins only partially recover, not even back to their peak, you can get to a valuation of around $27.50 a share. That implies a huge potential upside from where it's trading today.
But, okay, let's pump the brakes a little. To be balanced, we absolutely have to look at the very real, very serious risks that could completely derail this whole story, because a cheap stock can always get cheaper.
And make no mistake, the road ahead is a minefield. The turnaround has to deliver positive results, and soon. The credit rating is teetering just one notch above junk status. They're still burning cash. And then there's this CARB agreement, which legally binds them to sell a high percentage of EVs in California and other states, a huge competitive disadvantage. All of that while they're facing lawsuits and the risk that their key suppliers could go bankrupt.
So, at the end of the day, you're left with two competing stories. On one hand, you have a company that has suffered a truly breathtaking level of financial destruction. On the other, you have a business with massive liquidity, new leadership, and early signs of a turnaround, all trading at a historic discount. This leaves us with the one central question that every investor has to answer for themselves. Is Stellantis a deeply damaged company or a deeply mispriced opportunity?